Dip buyers, where have you gone? On track for a fourth consecutive day of losses. 30 minutes ago into the start of cash equity trading, I'm Danny Berger. Matt Miller is off the show today. Bloomberg Open Interest starts right now. Coming up, JP Morgan's Daniel Pinto warns AI valuations are due for a correction, while a potential AI bubble was ranked the biggest tail risk in a Bank of America survey. Meanwhile, earnings from Home Depot point to a weak consumer as the retailer faces mounting headwinds, and a widespread worldwide outage at Cloudflare blocks access to websites including ChatGPT, X, and the New Jersey Transit. I think this is like the second day that you're facing a delay if you're on the New Jersey Transit, so good luck to you. At least this time it's because of tech and not because of weather or rail derailment. Anyway, some of the stocks we're watching this morning, it's the big tech players. Microsoft and Amazon, both of them were downgraded at Redburn. The analysts calling their generative AI returns misplaced. Home Depot, they also cut guidance as shoppers stop buying those big ticket items. Those shares down 3.5%. Let's start on Home Depot. Let's get more on it. We're joined now by Bloomberg Intelligence Senior Analyst Drew Redding. Drew, your initial take on what we heard from Home Depot.
Yeah, so Home Depot is facing a lot of challenges, not altogether new, but the most important being a weak housing market. U.S. housing is really stagnant. Volumes are down about 25% from normalized levels. And what we're seeing, and I think what the difference here is heightened consumer caution. You have consumers who have grown increasingly cautious about the outlook for the economy, the outlook for their employment situation. So I don't necessarily think the underlying trends in Home Depot's business have gotten significantly worse from last quarter. They actually called things out as being relatively stable. The difference is their guidance last quarter had assumed an acceleration in activity in the back half of the year, and that has not materialized.
What changed? What changed that would have made them think that that won't materialize as they did in their last earnings?
So I think the hope for Home Depot and for the broader housing market was that we would get lower mortgage rates, and that would spur increased housing turnover. You'd get more big ticket purchases as people would become more willing to finance that. But as we've said in the past, rates are certainly a big component of affordability and crucial to what happens in housing. But they're not the only thing at play here. We've heard across the housing space, whether it's the home builders, building product manufacturers, and now Home Depot, is that there's just increasingly cautious consumer. And when you have, a poor sentiment in regards to the outlook for employment, you're less willing to take on those big ticket discretionary purchases. So think of things like kitchen remodels, bathroom remodels, flooring projects. And that's, one of the areas where we're seeing particular weakness.
Hey, Drew, thank you for that. Home Depot shares again down this morning. Drew Redding of Bloomberg Intelligence. Now, elsewhere on shares that are moving to the downside, Redburn has cut Microsoft and Amazon to neutral from a buy, breaking rank with peers. Analyst Alexander Haissl says that underlying economics of generative AI are far weaker than assumed, with high capital intensity and weak pricing power. Bloomberg Tech co-host Caroline Hyde joins me at the desk. Caroline, how rare is it to get a downgrade on some of these names that everyone, I guess, was loving and maybe not this morning?
Well, let's put it into perspective. Microsoft has 2 neutral ratings, 0 sells, the rest of them are buys. So Alexander's going out on a limb here more broadly, and you're seeing this similar with Amazon. Amazon has 0 sell ratings, a few neutrals, but most consensus, more than 90%, is these stocks are buys. In fact, we've seen the price target go below where Microsoft is currently trading at. $500 is below its 507 current levels. So clearly, this particular analyst and Rothschild more broadly feeling that too much is baked in here, too much optimism around the return, the margins in particular, because this rollout is going to take an awful lot of money. And the margins are not like they are in cloud more broadly. And he felt that really some of the innovation had more broadly been baked in with cloud. We'd seen actually the economies of scale make sense before the huge rollout and infrastructure build-out came. And now we're sort of building it and hoping they will come. And at the moment, people are still wondering how we're going to charge for all of this use case, particularly if you can't get on your ChatGPT today, like if you're impacted by Cloudflare.
Okay, can we just talk about that? Because I feel like, if anything, it just does underscore how much of this new future is being driven by infrastructure that is not even seen to us. I mean, how many people think about Cloudflare on a day-to-day basis? And because of that, the most popular AI app can't be used.
Yeah, how much are you thinking about Akamai? How much are you thinking about Cloudflare? How much are you thinking about your content distribution? If you use TikTok, you're using Akamai. If you're using, seemingly, ChatGPT, if you're trying to get the New Jersey Transit, if you're making out, it seems more broadly that you do need content distribution. You need these cyber companies to be fit and working. Now, we have heard from the company. We put in a statement. Matthew Prince joins the show often, and he's someone who's really worldly wise about the way in which we're adopting AI as well. They're thinking about AI agents, and particularly they want to be the guardrails and the protocol of our future of AI. Well, they need to be up online if we're going to be able to do that. They're talking about an unusual traffic spike that they've currently seen at Cloudflare. It began at 11:20 UTC. They saw the traffic, therefore, being an issue for them, and they are all hands on deck, they're saying, to make sure the traffic is served without errors, but at the moment, still errors occur.
It feels like the worst time to get downgrade to some of the hyperscalers that have concerns that ChatGPT won't work, because it does feel like a piling on recently of some real skepticism, and all that piling on coming ahead of Nvidia earnings. Can they do anything? Can Jensen Huang at this point say anything to soothe markets?
I mean, his numbers could deliver, and the numbers are going to be good. $55 billion is what the market price is in. That's a 57% increase in revenue. Extraordinary for an almost $5 trillion company. Bloomberg Intelligence have been saying we think they're going to beat, because remember, just back in October when we were hearing from Jensen Huang over in DC, he articulated that over the next year, he's got line of sight on $500 billion worth of demand for his Rubin and for his Blackwell infrastructure. If he can continue to show that level of demand, and that he's not seeing any falling away in capital expenditure, he sees AI really reaping rewards in terms of actual productivity, well, then we could steady the ship some. But at the moment, we need that fundamental base case, because the hopes and prayers about AI are starting to get a little bit quieter.
Yeah, Daniel Pinto not helping either.
Yes.
Maybe Jensen Huang needs a word with him. Caroline, thank you so much for joining this morning. Tune into Bloomberg Tech. It's going to be a big one today at 11 a.m. Now, the crypto market also adding angst in overall risk assets. Bitcoin fell below $90,000 for the first time in 7 months. It's just back above that level, but it did erase gains for the year. Crypto-linked stocks, those are sliding as well this morning. Scarlett Fu co-hosts the Bloomberg Crypto Show every Tuesday at noon and joins us this morning. Scarlett, I mean, it's been a tough run with these things. I guess it's hard to say what exactly is behind it, but what are some of the people you're talking to saying about this fall?
Well, definitely investors are repricing the early stage innovation, frontier tech parts of the market, and crypto really embodies that, right? We know crypto trades as a risk asset, especially with stocks, and in the near term, you mentioned Nvidia. There's anticipation before Nvidia's results, and then, of course, there's a lot of macro data at the end of the week, but overall, you've got a lot of concerns over the shifting macro environment. Is the Fed going to cut rates in December? Is the Fed going to cut rates in 2026? We don't know. Stretch valuations in stocks, especially that AI story getting a little bit wobbly, is just concerning for anyone in risk assets overall.
And I hear you brought this cool chart with you. What are we looking at, Scarlett?
So I think what this chart really shows, it's very busy, is that Bitcoin has repeatedly come back from massive drawdowns. So that big spike up in 2021, 2022, money supply is a purple line. And of course, during the pandemic, people were stuck at home. They got a lot of money. There's money sloshing around. So it went into unprofitable tech stocks, the white line, meme stocks, which is the yellow line, and Bitcoin, which is the blue line. The difference is, you could see in 2022, 2023, Bitcoin made a comeback. And even though the bubble deflated everywhere else, Bitcoin has repeatedly come back from these massive drawdowns, down 55% in 2021, down 77% in late 2021 to late 2022. So this idea that, perhaps there's another drawdown isn't so much super concerning. It's not an existential crisis for Bitcoin. It's like, okay, this happens and we come back from it.
I guess the question, though, is it a concern for other markets if people have been using leverage, if they're getting margin calls and they need to liquidate other assets in order to fund those margin calls?
Absolutely. So there's an element of forced selling, or at least questions being raised about whether there's forced selling, right? We know that a lot of traders borrow money to enhance their positions. So when the prices come down, they get exposed. And we're now looking at this $100,000 level. It was previously support. It's now resistance. And it's definitely this key line here. Options traders are also betting on further declines. We've seen a demand for downside protection at $85,000, $80,000 strikes. Those are dominating flows. And we've seen 12-spot Bitcoin ETFs see net outflows over the last 2 weeks of $2.8 billion in November alone.
All right. Well, Elisa, like maybe you can call today a bounce because we're back over 90,000. So
we'll see, though. I mean, there's Bitcoin
that.
trades 7 days a week, so there's a lot of room for.
Well, again, it is the day to tune in to Bloomberg Crypto. Scarlett, thank you so much. And again, that's at noon. And the guests today include former Hut 8 CEO Jamie Leverton and OpenSea CEO Devin Finzer. A check on futures this morning after 3 consecutive days of declines. We're headed for a fourth. The S&P and NASDAQ are down 4.5% respectively. It has been the worst run for the Russell 2000 in equal weight since August. For the S&P 500, the worst 3-day run since April. And it's been Nvidia leading that drop again. It's accounted for a quarter of the losses from the highs of this market. Some of the individual movers on a radar this morning. Klarna, they've agreed to sell as much as $6.5 billion of longer-term loans to funds controlled by Elliott Management. Elsewhere for Elliott Management, a busy day for them. They've built a large stake in Barrick Mining. That's according to the FT. The investment could be as large as $700 million. Intuit, they have struck a deal with OpenAI that will be putting applications like TurboTax and QuickBooks on ChatGPT. Those shares up 2%. You just got to hope Cloudflare works while you try to do your taxes. That would be unfortunate. Speaking of which, coming up, we're going to talk about that. What we know about the Cloudflare outage impacting AI chatbots, social media, tri-state transportation, all of that coming up next on Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. And we start with U.S. companies shedding 2,500 jobs per week on average in October. That's the latest from ADP Research. A number of large companies, that includes Amazon, Target. We heard they announced job cuts during the month. So that ADP snapshot of the labor market has helped bridge the gap. Official employment data was delayed by the longest government shutdown in history. The September jobs report that is set to be released on Thursday. Elsewhere, Saudi Crown Prince Mohammed bin Salman is meeting President Trump at the White House today. It's a rare visit for the Saudi leader, who's bringing a massive delegation to Washington. The two will sign deals on defense, nuclear energy, artificial intelligence. But analysts do warn that the partnership hinges on MBS's personal ties with Trump. So there are no guarantees that the agreements will survive future administrations. Finally, Blue Owl Capital shares tumbling to their lowest in 2 years after the firm froze redemptions from one of its private credit funds. The $1.8 billion vehicle will merge with Blue Owl's $17 billion listed arm early next year, but that leaves investors unable to cash out in the unlisted one and facing paper losses up to 20%. In a statement, Blue Owl says the deal strengthens returns and liquidity. ChatGPT, X, and the New Jersey Transit are among the companies impacted by a widespread outage that Cloudflare is working to fix. Let's discuss with Bloomberg cybersecurity reporter Jordan Robertson. Jordan, just at this point, for people trying to get into X, ChatGPT probably having a hard time. What do we know as to what's behind it?
Yeah, so the technology that's behind this outage is called Cloudflare. It's one of the world's biggest cybersecurity companies. Effectively what they do is they act as a buffer between your website and the outside world, and most importantly, criminal cyber attackers. And what that means is that if Cloudflare has a problem, so does your website. We've seen this before. Cloudflare is a very, very large company. They're essential to kind of modern cybersecurity on the internet, but it's had problems before, and it's had glitches. It's a constant target of cyber attacks. And what's happened today is, the Cloudflare service itself has been experiencing outages for a number of hours today. And the company itself has issued a statement that implies but doesn't confirm that there may have been some sort of cyber attack. The company has indicated that there was an unusual, what it calls an unusual spike in traffic to one of its services that may have contributed to this outage. So there's a lot we don't know at this point, but we do know this is a pretty prolonged outage that also illustrates how important this company has become to modern cybersecurity.
And it feels as though it has echoes, Jordan, to July of 2024, when CrowdStrike went down and it meant that airlines were delayed, a lot of Microsoft Windows run things couldn't operate. And after the aftermath of that, it was CrowdStrike faced a lot of issues, a lot of scrutiny that it took a while to work through, and maybe is still working through some of it now. What does it mean for a company like Cloudflare, for their reputation and for customers willing to use their software?
Yeah, Cloudflare, again, is one of the biggest and most important cybersecurity companies, in the world. Its market penetration and just the scope of its services, is really unmatched. And you're exactly right. What the CrowdStrike incident, showed was that these security technologies are deeply embedded inside digital infrastructure, whether that's websites or payment services or what have you. And, in order to implement these security technologies, organizations have to allow the security technologies to do things at a very deep level inside their IT infrastructure. What that means is if there's an outage, whether that's caused by a cyber attack or just a technical error or a glitch or a bad update, what that means is that there can be really widespread ramifications. And what these incidents kind of highlight is the degree to which these security technologies, they work mostly fine. They mostly work okay. But when they go wrong, it can have really lasting ripple effects.
Well, Jordan, I'm really excited because in just over an hour's time, we're going to be speaking to Martin Schroeter, who's the Kyndryl CEO, a spin-out from IBM. They run a lot of these consulting for IT tech and infrastructure for companies. And he's going to talk about the immense amount of spending on AI that companies are doing. Is there a real risk that companies have been siphoning their spend and investment into AI at the sake of IT infrastructure, at the sake of things that would lead to issues like this in the future, just because of the way that investments are being made in mostly and predominantly and more often in AI?
Yeah, we don't know enough yet at this point to kind of articulate what happened at Cloudflare, but I can, comment on generally what I've seen in covering cybersecurity for, a pretty long time, is that, companies are, of course, investing a lot in AI. They're spending a lot of money on, developing internal tools, trying to improve their cybersecurity, trying to improve their defenses against hackers. But I talked to a lot of cybersecurity professionals, and what they've told me is that outside of kind of some fringe cases where hackers are starting to experiment with AI-enabled technologies, that they're just not seeing a lot of actual use cases of AI being used by hackers. So at this point, a lot of this is kind of like preemptive posturing, if you will, and trying to preemptively plan for potential future attacks using AI. But just generally, we haven't seen a lot of it. And it could come to pass that, perhaps this Cloudflare incident was informed, or maybe there was AI involved in some way. At this point, we don't have enough information.
Hey, Jordan, thank you very much for this. That's Bloomberg cybersecurity reporter Jordan Robertson. A conversation I'm going to watch back as well as I wait for my ChatGPT to load. All right, a check on futures ahead of the opening bell. We continue to push deeper into the red, down by more than 0.5% for NASDAQ 100 futures. Your S&P down by just about 0.5% for a fourth consecutive daily loss after the worst three-day run since April. The VIX at a 4-week high. A lot of broad weakness. We'll see if turnaround Tuesday can take hold. So far, though, the dip buyers nowhere to be seen. Coming up, BlackRock's Gargi Chaudhuri says that the market outlook is turning neutral with fewer bulls and bears. She joins after the break. That's coming up next. You're watching Bloomberg Open Interest.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
JP Morgan Vice Chair Daniel Pinto at the Bloomberg Africa Business Summit. Bank of America this morning also flagging concerns in its monthly fund manager survey, where it says 53% of respondents say AI is already increasing productivity, but companies are overinvesting. That was the response for the first time in 20 years. Let's bring in Gargi Chaudhuri. She is BlackRock's Chief Investment and Portfolio Strategist for the Americas. Gargi, man, there's a lot of kind of bearish sentiment out there starting to swirl around AI. It feels like these have always been in the background, but it's finally starting to impact markets. A real sell-off, especially driven by Nvidia, occurring right now. Would you agree with the Daniel Pintos, the respondents to Bank of America surveys of the world, that there is some overhype going on right now?
Good morning. It's great to be here. Thank you for having me. So, I was obviously looking at the Bank of America survey, and we actually, and I shared some of these results with you guys, we do a survey of our own when we do client calls. where what we're seeing actually is quite the opposite. We're seeing about 66% of respondents are quite bullish AI, but unfortunately, or maybe fortunately, given the last couple of days, they don't actually reflect that in their portfolio. So they haven't quite had that overweight to AI and tech yet, but they want to have it. So that is what we're seeing from our clients.
That sounds like a good thing, by the way.
It is a good thing for now, and more importantly, it's good because historically, and especially in 2025, the other thing that we found is that buying the dip behavior has been quite strong, which has worked out for so far. So every time we have more than a 1% dip in the S&P, we've looked at ETF flows coming in that following week, and they've been about 20 to 30% higher than the non-negative weeks, so the positive weeks.
Right.
So there is that going on as well, and I think that healthy backups, cleansing, if you will, are good for the market.
What's the difference, though, between a backup and healthy cleansing versus just like a narrative shift that takes us down longer? Because there's a real fear that, okay, tech sells off, Oracle spreads widen on their CDS, that maybe this is more of a narrative that has longer legs. How do you kind of distinguish between
Absolutely.
the two?
Great question. And I'll say a couple of things. Number one, let's think about what has led to this more recent narrative shift. First, I would say it's the hawkishness or the perceived hawkishness from some of the central bank speakers that we heard from over the course of the last 2 weeks. That's number one. We'll have to see what happens with the data once we start getting it, right? So the second one, which has been somewhat surprising to me, has been the negative reaction despite strong earnings that we got over the course of Q3. I think it's surprising how strongly so many companies have beat, and given where the expectations are, looking at about 14% earnings growth, that's been a very strong sort of relative to expectations, a very strong market reaction, but we haven't seen that follow through. So maybe there's more there. And then the third thing I would say is just the absence of data. Once we begin to get that deluge of data on again, which will hopefully happen starting this week, I think there's going to be a little bit more clarity. So that's what we're looking at. And I'll say, if you think about, what sustains us, it's just fundamentals.
Okay, well, let's talk more about those fundamentals. After the market open, Gargi will be staying with us. That's coming up next on Bloomberg. We are just moments away, seconds, from the start of U.S. equity trading. You are watching Bloomberg Open Interest. I'm Danny Berger. Not exactly how you want to start your Tuesday, is it? Especially after a Monday that declined, a Friday that declined, a Thursday that declined, a three-day run that rivals the worst from April. S&P futures down 0.5%, NASDAQ down 0.6%. The Russell 2000 futures session also doing poorly. All right, here at the opening bell over at the New York Stock Exchange, we got MP Materials. What a great year it's been for them, up 265%. The rare earth minerals producer, they got some investment, some help from the U.S. government, so that's not too bad. On the other hand, over here, we have Chaggy Modern Tea House. It is a U.S. listed ADR of a Chinese tea company. They IPO'd back in April. Not as great for them. They're down about 13%. I think whoever was at the front of the podium there was just throwing leaves, maybe tea leaves, so that's pretty cool. But again, down 13%. All right, let's look at some of the stocks to watch this morning. And it's been a lot of the tech players that are feeling the pain. Microsoft and Amazon, both those shares are down roughly around 1.5%. They both got downgraded at Redburn. It's not too often you get downgrades on these companies. The analysts calling their generative AI returns, the hopes around them, as misplaced. Home Depot, those shares down 4.2% after cutting guidance as shoppers stop buying big ticket items. I want to, though, let's go back over to the desk because Gargi Chaudhuri is still there. She's, of course, BlackRock's chief investment and portfolio strategist of the Americas. So, Gargi, before the market opened, we were just talking about the ability for earnings to underpin things and the fundamentals. Torsten Slok has talked about a K-shape, not in the consumer, but in companies. Maybe Home Depot kind of underscores that this morning. How are you looking at fundamentals when you can have strength from many companies, but a Home Depot can say consumer strength is just not there for us?
So recognizing that there is very much a K-shaped recovery that's going on, and that will obviously have impact on equity markets and bond markets alike. So making sure that when you are thinking about your investments, investing to those quality areas which are likely to have that profitability, that ROI, that earnings growth, which is what we've been telling investors to do. So use this pullback, and maybe as we go into the year end, recognizing there might be further illiquidity concerns, but being cognizant of that and using that pullback to go into AI, which we still think is a very resilient part and earnings-led part of the market. And in particular, we're telling investors to go in with an active lens in mind. So BAI is the ticker that we're telling investors to allocate to for that high quality AI exposure. And then you ask about fundamentals. I'll just point to maybe two other things quickly. In addition to earnings growth, really focusing on coming into Q1 of 2026, we will see that reacceleration of economic growth. We might see some slowdown given the impacts of shutdown in the near future, but after that, we see that reacceleration. And then secondly, even if the Fed rate cuts do get pushed out in December, just listening to some of the Fed speakers, we will continue to have a rate cutting cycle back towards that 3% neutral rate in 2026, perhaps even in 2025. I think both of those are very positive for the fundamentals.
So a couple of things I want to ask about there. So you mentioned one of the tickers. I'm guessing that's one of the BlackRock ETFs to capture AI. Why do that and not just like an overall S&P 500 fund? Because aren't you essentially getting the same thing? I mean, Nvidia is such a huge weight. So why go into an AI-specific fund versus just market cap weighted S&P?
Yeah, no, it's a great question. And listen, there are certainly a lot of investors, given their risk tolerance and given their budgets, that are focusing on funds like IVV, which is exactly that. You get the S&P 500, and that is what you need, and you're still getting a large component of AI within that and everything else. But then again, as I said before, 66% of clients are looking for that AI exposure. They have an underweight to it. So in your portfolio, if you have discovered that underweight and you want that AI-specific theme only, you've got the industrials, you've got the financials, you've got everything else, but you're really underweight AI. That's where we think that very specific AI exposure makes sense. So it's really a portfolio decision.
Got it. Okay, so the other thing you mentioned is the fact that cuts are on their way. But we've had a lot of division among Fed speakers. We had more recently one of the first Fed speakers to really come out and say, yeah, we're going to get a December cut. It feels like a lot of the Fed governors have been actively avoiding that conversation when we've had Williams more recently being more dovish. Is that enough, you think, to turn around this market in the negative sentiment? Getting cuts priced back into December, is that going to be the thing that saves equities from this downfall we're on?
I think that some of the reason that the downfall happened was this divisiveness. Because think about it, we haven't had any data at all. What have we had? Yes, we've had earnings, but those haven't been bad. What else had we had? We've had the divisiveness. So I do think if we get some more clarity, and frankly, some of that clarity will come from many of the payroll prints that we're going to get, the three of them that we're going to get between now and call it end of December. And within that, if we see that, the economy is not slowing down massively, but there is still a slowdown in the labor market, I think that allows the Fed to be able to cut. And especially with inflation, if we continue to see services inflation decelerating as we did in the last October 24th print, I think that allows them more sort of firepower, if you will. Is it enough? No. But that in combination with the growth dynamic that has always been positive and will probably accelerate in the beginning of next year, as well as earnings growth dynamics that, again, has been extremely powerful and positive and higher than expectation, I think all of that does allow for us to have a smoother year-end process.
If divisiveness, though, is the issue, Evercore brought up this really interesting point last week, and their idea is essentially that what's happening now is you're getting Fed speakers who are being more hawkish because they're anticipating a Trump pick coming in to run the Fed. And they want to get out ahead of it and show that they're not just going to roll over and listen to whoever is in at the Fed. Does that show, or are you concerned that the divisiveness is going to continue into 2026, that this is just the new posture of the Fed? And if it is, does that mean the rough patch that we're seeing now might be more common?
If that is the case, I think that'll introduce more volatility for sure. Because markets, more than anything, like certainty. They like certainty of data, certainty of policy. And I think some of this wobble has been certainly illiquidity, but uncertainty as well. So if what you're postulating is correct, then yes, I think that'll inject more volatility. But at the same time, isn't that a great opportunity to choose and pick and prepare your basket for those areas of the market that you really want in your portfolio. So fixed income, we think, sort of clipping that coupon in fixed income markets is a great way. And again, if we have these spread widening periods, great way to allocate more to fixed income. Similarly, with high quality parts of the equity market, this is a great time to do that. And then add some hedges. We've been talking about that from the beginning of this year. We've seen this massive 50% rally from the April lows in tech. A pullback is normal, healthy. Add some hedges, add some gold, add some front-end bonds, add some non-US market. Emerging market comes to mind. And I think that diversify your portfolio, and that's another way in which you can weather the storm, if you will.
Gargi, I'd love to end kind of where we started on this idea that a lot of your clients still are underinvested to AI. When you talk about them and investing in AI, is it hard to convince them to go all in, especially sort of the headline risk that we keep seeing every day, that companies are overinvested, that maybe there's a bubble? Has that kind of dissuaded some people from really getting into the trade?
I think that's sort of come up a lot more over the last month or so with respect to, is AI in a bubble? That really wasn't a narrative at all. I think it's come through now with the fears of circular financing, which is why, in fact, it offers us more of an opportunity, you and I, to sort of help clients to understand where you should be thinking about picking stocks and what are some areas of the market, frankly, like small caps, which might not ever get their shine back.
All right, Gargi, this has been so fantastic. Please come join again soon. That is BlackRock's Gargi Chaudhuri. All right, about 8 minutes into your trading day, let's see where stocks stand right now. They are lower and, not as bad as we were in the future session. We're down by a third. Looking at the upside, Apple, one of the biggest gainers in terms of points. It's only up 0.7%, but there was a report that maybe some of their sales in China are doing better than expected. Alphabet, Broadcom. By the way, Alphabet, kind of the thing that saved the market yesterday or made it not as bad after that Berkshire Hathaway investment. To the downside, it is Nvidia. This continues to be the thorn in the side of the market just because of the weighting of it. It's dragging the S&P down 8.5 points. It's down 1.6%. It's going to have earnings after the bell tomorrow. But shout out to Dan Curtis pointing out that it's contributed to a quarter of the S&P's fall from the top. Microsoft close by, Amazon, Meta, Amazon and Microsoft getting that downgrade from Redburn this morning. Let's look at some of the sectors. Might not surprise you that tech is one of the worst ones, down 0.7%. Consumer discretionary, a lot of that's going to be Home Depot. Home Depot with those disappointing earnings dragging down lows. We're also going to hear from Walmart this week, from TJX, from Target, so we'll get some other consumer names too. At the top, we have staples, utilities, materials. It's that little bit of a flight to safety kind of flavor this morning as we are down by at least 1/3%. Coming up, we're going to hear those comments again and get more into them from JP Morgan's Daniel Pinto, joining the growing choir of those warning about a potential AI bubble. That's coming up next. This is Bloomberg. You are watching Bloomberg Open Interest about 15 minutes into your trading day, and we're on track for the fourth consecutive day of losses. S&P, the NASDAQ down. NASDAQ underperforms, down almost 1%. But not that much is being spared. The Russell 2000 down 1/3%, so not as bad. Where do you go for hedges? We're just speaking to Gargi Chaudhuri of BlackRock, saying that gold is something you certainly want in your portfolio. We've seen how popular that's been. That's up 0.8%. Looking at some of the individual movers this morning, Cloudflare down 2.5%. An outage there. We don't know why yet, but it's shut. Things like ChatGPT's OpenAI's ChatGPT. X is having problems. The New Jersey Transit is having problems. So I am so sorry if you're in your morning commute this morning. Bitcoin, that also continues to fall, was under 90,000 at one point. Home Depot, some poor earnings from them. Those shares fall 3.3%. But here's the weird thing about this environment. They say the consumer is weak. But look at Amoroso. Those shares up 7.33%. They've boosted their full year earnings forecast. They're seeing sales accelerate. Their brands like Wilson, as well as Solomon, because everyone owns those shoes right now. It's like the Adidas ones, what those used to be, but now everyone's wearing the Solomon ones and looking like they're about to go on a hike, but like in the middle of West Village. I don't know. I don't get it. Nvidia, those shares are down 2.3%. It's the big cap tech, the fear of an AI bubble. Also, the darling children like Palantir Technologies that are so richly valued, having a bad day on that. Now, on that front, JP Morgan's Daniel Pinto, they are warning of a possible correction in AI valuations. Pinto sat down with Bloomberg's Readiness Gargi at the Bloomberg Africa Business Summit in Johannesburg. They discussed the AI bubble debate as well as other risks facing investors.
What we are not seeing is a deterioration between what we were expecting in the credit cycle in any of the portfolios. So I think that credit remains solid from credit cards in the US all the way to big corporates. But we will see how it plays and continues once the economy. I don't think that the economy will go into recession. It's likely to slow down. And the credit cycle will continue to normalize, but I don't think that in the credit cycle we see a deterioration beyond what we were expecting.
If the economy slows down, where do you stand on the interest rate debate in America at the moment? Do you think the Fed is going to cut again in December or hold off?
I think that it may be some inflation is being quite resilient. Low growth is slowing down. But it's still, this quarter, I think that we should discount the numbers wherever they can because of the shutdown, that it will recover, whatever it is, it will recover in the next quarter, in the first quarter of next year. So we do see some deceleration. We do see some reduction in consumption, but it's still for healthy levels. So I think that the economy may grow less next year, but most likely it will avoid recession. Tariffs, they haven't had the full impact, but some will have a further impact next year, but also some will be compensated by the fiscal expansion. So I am relatively positive on what we are seeing. Having said that, markets are pricing a very, very benign scenario and quite a bit more. So that I don't know. There may be issues or not, but the S&P at 6,700 or so, 23 times is quite healthy, to say the least.
You're not giving us a new S&P target.
Well, whoever was giving target missed it all, so no. But I think that from here, you would have saw that the upside is relatively limited.
Obviously, no on-stage interview these days can't include AI. So here's the AI question. Where do you stand on the continuum of hype, bubble, and it's going to solve everything?
Well, the technology is real, and we are, even though we've been dealing with traditional AI for the last 10 years. We are now working in large language models, and we deploy that to almost every employee that we have. We are using different forms of this to improve productivity across operations, technology, detecting fraud, surveillance, credit decisioning, improving client experience. It's all over the place, but it's still at a very early stage. So large language models that are still not having the impact that they should have, and we're still very, very early in the agentic journey. Clearly, this will have an impact in the labor market. Some jobs will be created and some jobs will be eliminated. But I think that one thing that ones want to keep an eye on is how much capacity is being created, and how all these companies, how much revenues they are going to get to compensate, to pay for that capacity. Is likely, I don't know the probabilities, but it's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
JP Morgan Vice Chairman Daniel Pinto speaking with Bloomberg's Schroeter at the Bloomberg Africa Business Summit. Now let's check back in on Cloudflare, which says that its outage should be over. Shares are still falling this morning. They're down 1 1/3%, but they were down as much as 2.5%. They say that they have implemented a fix. We're going to have more on that story coming up, as well as a downgrade for Microsoft and Amazon. That comes just ahead of a market-moving report from Nvidia tomorrow. That's coming up next. This is Bloomberg. Let's get you some top calls this morning. The analyst action that we are watching. First up, Honeywell. That gets its first sell recommendation on the street. It comes from Bank of America. They expect shares to lag as elements of its spin-off strategy disappoint investors. Analysts there also say that the company likely will not deliver earnings growth next year. Those shares down 1.6%. Next up, Wells Fargo initiates coverage of Flutter Entertainment with a buy rating. Those shares up 2.2%. They see a compelling valuation following a recent sell-off. The analyst is positive on management and says that the stock provides exposure to high-growth digital markets. And finally, the bull case for generative AI may be losing steam. Analyst Alexander Haissl at Redburn is cutting his rating on Microsoft and Amazon to neutral, saying the Gen AI boom is not the next cloud. He says weak economics, costly infrastructure, fast depreciation hardware raise the risk of an industry overbuild. Let's dig into some of this and some of the recent outages in tech that we've seen this morning that have been weighing on the AI players. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, we can get to those downgrades in a moment, but we just heard from Cloudflare very recently saying that they have fixed some of the outages. Just what's been going on this morning? It feels like a particularly chaotic one.
It was, and actually they haven't said why. There was a surge in traffic. They now need to understand what that surge in traffic was and why did it so destabilize their offering. But this is a content distribution network. This is what makes your apps work, your websites work, and ultimately many didn't today. Whether you're on X, whether you're trying to do ChatGPT and get all your productivity done, or food jukes for your kids, as I tend to use this morning, or whether it's just trying to commute, a lot of it suddenly went offline. Immediately, they said they were trying to tackle this. They were all hands on deck. Now it seems as though it's fixed. We're back up and running. But really, the question is going to be how, why. And this is a company that was trading at a record high just at the end of October because it had started to win more big enterprises. They serve a lot of medium, small-sized enterprises on content distribution and on security. But they're also trying to put themselves as the new AI agent protocol and guardrail as you build out your AI offerings and Gen AI. They can help you get there. This is going to make people question just a little bit how effective that can be and what Matthew Prince is going to have to say to steady the nerves of many.
Yeah, it doesn't sound great if you're billing yourself as the guardrail, but you're literally the reason and the biggest AI agent goes down, but also feels very old world meets new world. The fact that you have a train system go down at the same time you can't get into OpenAI's ChatGPT. I mean, does that show us kind of where this world is headed? That we're becoming so reliant on AI and it could have the same problems as the New Jersey Transit does.
Or indeed, we're so reliant on very few players to help our world work when it comes to infrastructure. Look, CrowdStrike, how many of our flights were delayed, how much of our world was upended when they had a particular incident, and we couldn't get onto Microsoft, we also couldn't board a plane. We are at this moment questioning that there are too many big players with too fewer roles. Not only are they all helping finance one another, but they're also just helping with the build out more broadly, not just in the United States, but worldwide. Europe is totally dependent on a few key big American players as well. The anxiety continues to build. I mean, we're all about one key stock really at the moment. Nvidia is in large part to blame for the 1.8 trillion that's been wiped off the NASDAQ since the end of October. It's contributed $500 billion of that erosion, and now we want to get some fundamentals. Are we baking too much on a few big companies that are going to be our future of production, productivity, and commuting?
I was say, lucky us, we hear from them on Wednesday.
I know.
Just quickly, Caroline, I mean, how are expectations set with the recent sell-off?
Well, sometimes it doesn't always matter. Jensen Huang has, for 12 straight quarters, beaten on revenue. We're expecting 57% increase in revenue. That's a great number for a company that's worth more than $4 trillion. But what can he signal about the future adoption? He's already told us a lot. What more can he say than I've got $500 billion worth of demand that I can see for my Rubin, for my Blackwell architecture? He's going to have to steady nerves, maybe tell us a little bit about China. But also, I think going back to that two fewer players and two bigger pies, he has still got a lot of concentration risk. Two key cloud companies are basically 39% of his entire revenue. How is that spreading out? How is he seeing sovereign AI get outside the United States and outside of a few key players? How are enterprises adopting it?
Yeah, it feels like a make or break earnings report, just given what's happened this week. Caroline, thank you so much for joining us. Bloomberg's Caroline Hyde. Coming up in the next hour, conversations from public to private markets. Stay with us on Bloomberg Open Interest. "30 minutes into your trading day." Bit of a painful trading day. It is Bloomberg Open Interest. I'm Danny Berger. Matt Miller is off. S&P 500 and the NASDAQ at the lows of the session this morning, trading at the lowest in a month. Coming up on the show, JP Morgan's Daniel Pinto warns that AI valuations are due for a correction, while a potential AI bubble was ranked the biggest tail risk in a Bank of America survey. This hour, strategist Anastasia, Amoroso, tech investor Rachel Arnold, plus CEO of Kyndryl all weigh in on the AI warnings as they stack up. And Saudi Crown Prince Mohammed bin Salman meets with President Trump at the White House for talks on defense, security, and energy. Now, we begin with that growing chorus on the warnings about a potential AI bubble. BlackRock's Gargi Chaudhuri pushed back.
We're seeing about 66% of respondents are quite bullish AI, but unfortunately, or maybe fortunately, given the last couple of days, they don't actually reflect that in their portfolio. So they haven't quite had that overweight to AI and tech yet, but they want to have it. So that is what we're seeing from our clients.
Joining us now is Anastasia Amoroso, Chief Investment Strategist at Partners Wealth at Partners Group. Anastasia, thank you so much for joining.
Good morning, Danny.
God, it feels like a lot of angst right now in this market,
Yeah.
whether it's about the Fed or about the AI. When you look at sort of the downtrend we're seeing, how do you distinguish this is a narrative shift and there's a meaningful concern about AI versus a dip you'd want to buy?
Right. I mean, I think if you step back and you look at the chart of the S&P 500, it has been a picture-perfect rally, really, since that dip that we saw in April, and every pullback has been bought, and, you know, we sort of stayed above the trend line. So I think it's understandable that people are maybe even tired of this sort of perfection or scrutinizing, you know, some of the best performing trades, whether it's in AI or the market broadly or private credit. But I will say that when you take a step back and look at the fundamentals, we're on the eve here of Nvidia earnings tomorrow. I do think that despite all the worries about financings and GPU depreciations and you know, just valuation levels, it's all about the demand. And as long as the adoption curve in the U.S. economy of AI continues to rise, that should be the most important thing. So it's maybe in a way it's great that valuations are being scrutinized. Investors are asking the questions. Maybe that actually keeps the lid on valuations going higher. But I think at the end of the day, Nvidia and the likes are likely to affirm just how strong demand for AI remains.
So a lot of the revenue that's been coming out of corporate America, though, is because of AI, because of the spending. I mean, I'm just looking at some headlines crossing now that Bloomberg, Nvidia, and Anthropic have announced strategic partnerships, so they become ever more intertwined. Is there a risk that it's not necessarily a stock market price bubble, but like a revenue bubble, that so much of this market and the capital that's being deployed is coming from AI? So if that changes, that leaves a big gap.
Look, of course, that is a risk. You know, if that equation changes, if that formula does not work anymore, yes, not a lot of things in the markets are going to be sustainable. But let's break this up. You know, we've got hyperscaler CapEx, and you've now got, you know, other companies jumping in and spending on data centers. Then you've got those hyperscalers that are building cloud capacity, and they're renting that out. They're generating cloud revenue, and their customers, the likes of OpenAI, xAI, Anthropic, and others, they're buying the cloud capacity because they're running their own AI large-scale models, and they're selling it to us as consumers, but they're also selling that to enterprises. So the really, you know, big thing of the part of the equation that I look at is whether the likes of OpenAI and others are actually generating revenues, and if that revenue growth is scaling up. And I'll just give you one example of OpenAI. I mean, they did publicly disclose that they're on pace for $20 billion annual recurring revenue, and that's, I think, this year. But if you look at some of the industry forecasts, that could scale up to $176 billion by 2030. So So as long as that equation holds, right, and we hope that it does, as long as that holds, that I think a lot of what's happening elsewhere in the ecosystem is justified.
Can I just ask, because you're constantly speaking with clients and on the road.
Yeah.
We've seen a lot of these surveys come in. Just this morning was the Bank of America survey saying that a majority of their respondents are saying that there is overspending happening. Are you kind of hearing some of the same feedback? Are there some real concerns out there just about the sustainability, even if you offer sort of this picture as to what would be sustainable?
Yeah, I'm so glad you asked, because I have spoken at a number of large conferences over the last couple of months, and it's interesting because the number of questions you get about artificial intelligence just really by and far outnumbers all the other questions that you get. So I think that's what people are curious about. But when I sometimes reverse the question, I ask the audience, well, what do you think we're in the AI bubble? Very, very few people actually raise their hands. And so what that tells me is that I think everybody is listening to the narrative. They're cautious as to whether they're stepping in at exceptionally high valuations, but I don't think most people actually want to miss out on what is the largest commercial opportunity that we have today. They want to be smart, they want to invest at the right level, but they also recognize the opportunity set. And once again, to me, that is likely what, the Nvidia report is likely to remind investors of, is don't lose sight of the AI opportunity.
So we're going to get the Nvidia report. We're also slowly getting data trickling in, even like surprising us overnight at 3 a.m. with the weekly jobless claims, because why not? Payrolls comes on Thursday. What is the bigger thing for this market? Is it payrolls? Is it some of the earnings? Or is it just like Nvidia earnings specifically that could help turn things around?
Well, it'll be Nvidia earnings on Wednesday, on Wednesday after the market closed. But it does boil down to also what's happening in the labor market. And I think one of the reasons why this market upside has not been sustained is because the odds of a December rate cut have been pushed lower. And so if we do get yet another weaker payrolls report than expected, then I think those odds go up. And, that in a way has become important to the market because, look, the economy outside of AI is struggling somewhat. If you look at the layoffs, they're happening in government, but that does dent consumer sentiment. They're happening in retail and warehousing, and maybe that's because consumer is not spending as much, or maybe it's the bite of tariffs. So either way, there's cyclical parts of the economy outside of AI that do need to be supported. So that's why I think the markets really want that rate cut in December as well to shore up the rest of the economy.
So for sectors like consumer discretionary, for example, we heard Home Depot that had some poor earnings. Can you buy into those sectors until you get confirmation that the Fed will be cutting and be cutting consecutively? Or is it too early right now to start to play that?
No, I actually think it's a pretty good time to step into something like consumer discretionary, especially going into the holiday season. It should be a seasonally strong time period. And also, if we do look at consumer spending in October and early November, it's pacing well. So I think you have some positive momentum there. And that's despite the fact that consumer confidence plummeted in the midst of the government shutdown. But here we have the government that is reopened, the flight schedules that are also reopened. So we have the government workers that should get their pay back either this week or the week after next. So all of that sets us up nicely, I think, for this rebound in consumer confidence into year end and into the holiday season. And if on top of that, we do also get the odds of a rate cut rising once again, which I think we will, that really solidifies the consumer case.
In this overall market, the retail investor has emerged more and more as a pillar in their participation of it. When you look at something like crypto, falling below 90,000, it's back above that level at a moment. I'm not necessarily talking about your call on crypto itself, but when you look at that, does it say something about broader retail participation, that maybe they get margin calls, they have to sell out other things? Does it in general just make this a more vulnerable market?
I think what's likely happened in the last few weeks is there's been sort of a reassessment of whether all the catalysts that have supported the markets are going to continue. There's been a bit of a reassessment on the strength of the AI momentum, a reassessment of whether the Fed is going to cut interest rates or not, and just a little bit of a look around. Look, if you look at the Max 7, Schiller PE, it is at 74 times or something like that. So I think there's been a bit of a pause in that. But Danny, I go back to that, my own personal survey of the audience, is because most people don't actually think we're in the AI bubble. I think these pullbacks will be bought. And what is a step back, I think, from the retail investors, I would assume, will be that buy the dip moment into year end.
Well, what a buy the dip moment it is today. Thank you so much, Anastasia, for joining us.
Thanks,
Anastasia Amoroso of Partners Group. All right, let's recap some of that breaking news that I mentioned moments ago, that Nvidia is committing to invest up to $10 billion in Anthropic. Microsoft committing to investing up to $5 billion, and Anthropic committing to buy $30 billion of Azure compute capacity. She thought she might have a break this hour. Not so. It is Bloomberg Tech co-host Caroline Hyde who's back around the desk. It's one thing after another this morning. I got to say, I was looking at the Microsoft share prices when this hit.
Yeah.
It did seem to help them. I mean, I feel like, is this kind of the worst time to announce more investing in each other? The market is, I don't know, not taking it that well.
I mean, it feeds the beast, doesn't it?
Yeah.
The idea that everyone is paying everyone else to keep on being their partner. So Anthropic's, yes, committing to buy Microsoft Azure, so access to its own cloud provision, but it's still saying, look, Amazon is actually my #1 provider of compute. So Amazon's out there trying to say AWS is safe, but just these large language model developers have such an underlying need for compute that they have to go to everyone. Remember that OpenAI was exclusive to Microsoft. Microsoft and OpenAI have a different kind of relationship now. So OpenAI can get compute from Oracle and get compute from loads of other players. In the same way, Microsoft can start backing other generative AI LLMs. And so here they are, more embedding Anthropic's Claude. Now, Claude was already available within Microsoft's offering, 365, but we're just deepening those ties. And more broadly, we're getting, what, a $10 billion commitment from Nvidia, a $5 billion commitment from Microsoft in the equity of Anthropic. And this is as Nvidia is also saying, we're going to work more closely together to make sure that these LLMs are far more efficient when they use our kind of architecture, when they're building on Blackwell, when they're going to be gearing out into the world of our Rubin architecture, the next set of chips. We're going to make sure that this is fit for purpose. So they're all trying to say we're playing safe and nicely here in this big scheme.
What tends to be the thought process of not just like a partnership, but of actually taking equity in the company? Why do that and tie your fortune even more so to a company? It has this feeling of kind of betting the house on these companies that they will succeed.
And in many ways, maybe it's what Anthropic needs for saying, look, Nvidia, Microsoft, you've both got equity in OpenAI, signal some support of our underlying offering here too. You continue to buy our equity. Your fortunes are tied to our fortunes. We'll make you a success if you make us a success. And therefore, it just ties in Microsoft to more broadly offer cloud in a more equitable manner, perhaps, to what they have with OpenAI. But remember, their exposure to OpenAI is much higher. And then you have the likes of Nvidia trying to ensure that it has demand for its GPUs going forward. No wonder they want Anthropic to be a success, OpenAI to be a success. All of it. This is the key question, though. Are these going to end up being commoditized in some way? Are we going to care whether we're using Claude or whether we're using OpenAI more broadly if all of them are going to be powered on the same sort of underlying technology?
Caroline, thank you so much for joining. You've just replaced Matt for me this morning, and I'm very thankful for that.
Me too.
Caroline Hyde. Of course, Bloomberg Tech will kick off in about 50 minutes time, a show you can't miss this morning. Coming up, more on AI and tech. Rachel Arnold of Vista Equity Partners will join us to discuss why software will be the ultimate beneficiary of AI. That conversation coming up next on Bloomberg Open Interest.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
JP Morgan Vice Chair Daniel Pinto at the Bloomberg Africa Business Summit. Let's bring on an expert in AI, in tech. Joining us is Rachel Arnold, Vista Equity Partner, Senior Managing Director and co-head of the Endeavor Fund, which focuses on small cap software. Rachel, great to see you this morning. Thank you for joining.
Thanks so much for having me.
And I was so excited to have you on just because of the conversation that's happening with AI, because this is something you work on in and day out, whether it be originating deals or working with companies in their AI strategy. Those concerns we just heard from JP Morgan, this idea that the promise isn't there yet and we've gone too far, that things are overpriced. Is that where we are right now, that the promise is a little bit more than the reality?
I think that is the big question of the year, isn't it, Danny? And I think that when you look at where the value has really accrued, it has been more on the semiconductor and hyperscaler front. What we have not yet seen is that value pull through to the enterprise software providers, the ones who are actually going to be bringing to life the agentic and the AI technologies inside corporate America. And I think that's really where we feel like the true value will be unlocked long term.
Why do you think we're not there yet?
You know, I think when you look at a lot of the use, it's happening at an individual and consumer basis. What we haven't yet seen is that teams, functions, and entire organizations are using it consistently enough to actually automate their workflow, which is where you're going to get incredible boosts in productivity and efficiency. And so when you think about this next chapter, we're at very early innings of actually unlocking the economic value of what the potential is here.
I'm sure you get the question a lot of like, isn't AI just going to eat software? Especially with enterprise software, when you could have someone like Levi Strauss announced yesterday that they were partnering with Microsoft to help them with some of their infrastructure, their IT infrastructure, and using AI. So to those who would say, look, this is a company that doesn't need a Vista-owned company that can use AI, that they can just go straight to Microsoft, what do you say to that? And that these companies are durable and can fight off some of the issues coming their way?
So what we've continued to see is that enterprise buyers are looking for an established partner to bring these solutions to them. Most organizations, especially in regulated industries, cannot have an AI startup agent running around inside their firewall. It's like, you know, agents gone wild.
Right.
And so instead what they're looking for is an established player that meets their security standards, that passes their data security checks, who can bring in these agentic solutions in a way that integrates with their entire environment and ecosystem. And that's where the existing enterprise software providers really play. And I think it isn't so much that software itself stays the same. Agentic will become the baseline of everything that software brings to life. But enterprise buyers want that relationship. They want someone to trust that they can call that actually, again, meets their standards and has auditability.
You're looking in a really interesting place because they're smaller cap companies. They're more sort of mid-market. So they're not startups necessarily, but they are not too far removed from their past of being a startup. When you're just evaluating companies, is there a lot out there? Like, how competitive is this space, and how difficult is it to discern the winners versus the losers?
Such a great question. So over 100,000 software companies today, 96% are private, 90% are under 50 million in ARR. So when we talk about what's happening in the software market, a lot of the innovation and the movement is happening in the small cap space. What we look for are mission critical software players. So these are companies that somebody uses to do their job every day, clean tech stacks, where we can then help them agentify their solutions to actually create that long-term economic value for the corporate environment. And I think when you really take a step back and you look at what's happened in the corporate P&L, it has been stagnant for a number of decades. And so a lot of corporate leaders are looking for new ways of innovating inside of their own P&L, creating more efficiency, more productivity, but also new growth vectors. And that's where a lot of these players really are going to make their mark.
I'd love to know, how are you and your team using AI in the investment process?
I love that question. I mean, you know, from a Vista standpoint, we have been all in on AI for a number of years. And, you know, what we have seen is that this is really about how do we augment and support our teams by giving them the best tools possible. It's everything from automating how you look at a confidential investment memo, all the way through to tracking back and looking at some of our portfolio results over a multi-year, multi-cycle period. And so it's really about giving our teams the very best technology, analytics, and insights, and then really automating a lot of the rote work, because at the end of the day, you know, we are a people product, and the strength of our teams is the strength of our toolkits.
But what's the line between this is a productivity enhancer and existing employees can use this versus replacement? That some lower level jobs, some of the grunt work, that AI can completely take that, and it just means maybe you need less people at Vista.
I mean, short term, that is not part of the discussion at all. It's much more about innovation and augmentation. I think long term, across all service industries, we will see a reduction in force more in the 5 to 10 year cycle. The technologies aren't yet mature enough, though, to the point where we're actually replacing humans with them. And I think what you look for long term is, again, how do we start to elevate the work and make it more strategic so that our teams can really step up and do their best work and actually remove some of, again, that rote processing that can be done from an AI standpoint.
What about your portfolio companies? Same sort of things, not yet replacing coworkers, or is that workers, or is that starting to happen?
That is starting to happen. So our portfolio companies have leaned in hard, and part of that is because, again, we're so deep from a methodology standpoint on AI. What our portfolio companies have really focused on is remaking their P&Ls with technology first. That looks like actually looking at the processes and the solutions that are out there and using the best of the best to actually create long-term differentiation and value. You know, most of the early results we're seeing are in functions like customer success, marketing, engineering. You know, engineering where we're seeing 100, 200% productivity gained by using code generation tools. You know, marketing where you're starting to see incredible content development tools and technologies. Again, automation that replaces what you might have sent to a third-party service provider or a PR firm or a content bureau in the past. And so when we look at what does the mark of a quality software company really, you know, represent? Historically, it was getting to Rule of 40, which is growth rate plus EBITDA margin percentage. Now we're looking at Rule of 60, Rule of 70. And I think in 2026, we're going to see more of those points get on the board.
Rachel, before we leave, I'd love to kind of zoom out because obviously what you do is, first of all, so fascinating, but incredibly specialized. And it's a time when a lot of your peers in private capital are trying to be everything to everybody. Is it harder right now to be a specialized shop? Is it an advantage as everybody broadens out? How are you thinking about that?
You know, one of the strengths of our firm has always been that we've stuck to our knitting, mission-critical enterprise software companies since the year 2000. And our mission has always been to unlock economic value for our LPs by just staying focused on that. I think because we're at such early innings on such an exciting transformation in enterprise software and broadly, again, you know, the enterprise ecosystem more broadly, there couldn't be a better time, not just to be invested in software, but also to be a specialist here.
Well, things are changing so fastly, so you have to come join us again, Rachel. We could talk all day. Unfortunately, we're out of time. Thank you so much. That is Rachel Arnold of Vista Equity Partners. Okay, still ahead on the show, more AI. It is the day of AI, and maybe some fears. We'll speak to Kyndryl CEO Martin Schroeter on what he sees as many companies stuck in AI pilot purgatory. Rachel was talking about the adoption of AI in companies. We'll get into that more, and we'll discuss exactly what it means. You are watching Bloomberg Open Interest. I check on markets just under an hour into your trading day. It continues to be a rough one. We continue to fall based on some of the AI names, and that's why NASDAQ 100 falling 1.3%. The issue in large part comes from a Redburn downgrade on Microsoft and Amazon. So those shares have been falling in the market. The S&P 500 is down 0.8%. Coming up, Kyndryl finds many AI investments are failing to produce a return. We'll speak with Martin Schroeter, Kyndryl Chairman and CEO. He joins us next. Companies are pouring money into AI, but so far, nearly half aren't seeing a return on that investment. At the same time, 62% are stuck in pilot purgatory, unable to get past the experimentation phase. That's according to Kyndryl, an IBM spinoff and one of the largest IT infrastructure services provider. I'm pleased to say that joining us now is Martin Schroeter, Kyndryl Chairman and CEO. Martin, there is no one else we'd rather talk to today because it feels like there's some real fears percolating in this market, that there is hype, things have gone too far, there's too much pricing, considering you work day in and day out with companies trying to implement AI. What is the line between there being hype and real promise?
Well, there's certainly hype, and it's nice to be here. Thank you. There's certainly hype, right? And the hype on the investment side is very real. We read about it. For our customer base, and we run the infrastructure that makes the world work. We run the banking systems, the telecom systems, the supply chains of the world. And what we're seeing day in and day out is that our customers are struggling sometimes to turn pilots into scaled work. And we think, and we see a couple of patterns that cause that. So sometimes it's skills. They don't have the skills they need to really bring these things to scale. Sometimes their architecture, their infrastructure is just not up to it. So we are seeing a sort of a challenge that our customers are having from pilot to implementation. But at the same time, we also see some really good examples of how it's coming and it's working in certain places.
What's the strategy? Is it a slow implementation with slow spending, or is it kind of like the Meta playbook, which I realize is a whole different beast, but this idea that you can't overspend right now and spend first and then kind of backtrack and figure out exactly how you're using that AI technology?
Yeah, I think it depends on your goal and what you're trying to accomplish. So in our customer base, we see every one of these business cases built on productivity. And I think that's almost a limitless at this point opportunity. So you can probably spend a bit faster on the productivity side. Converting that, and some of the business cases are built on growth, that might take a little bit longer. So I think you can get ahead a little bit too fast on the growth side of this, but productivity is very real. It's here now, and we see customers gaining lots of benefits from it.
I was going to say, in some of the statistics for your readiness report that you put out last month, that nearly half of the companies aren't yet seeing a return on investment. I got to say, I actually think when I saw that, I was like, that's not too bad considering how new the technology is. But how quickly does that need to change and to see a real return to justify some of the spending that is happening?
Yeah, look, the absorption, the consumption of this, driven by productivity, is probably right on pace. I don't think, again, that the investments that the hyperscalers are making, the investments that the world is making to get ready for that infrastructure, that can continue at pace. How much of this is going to drive new business models and new growth? That's still a sort of TBD. We have to figure out if that's capacity that might get absorbed much later.
An AI winter of sorts if you don't see that growth trajectory evolve? Could you see some serious pullback from companies and rethinking of AI plans if they can't figure that piece out?
I don't, from the work we do, I don't think there's an AI winter coming. We have enough examples now of customers completely re-engineering, for instance, their Know Your Customer, their KYC process to bring new customers on faster. We see plenty of instances in insurance where they're using AI to file all the regulatory documents that they need to file. These are real, they're here today. We see governments starting to invest, so they become more attractive to do business. So I don't think we're going to see an AI winter, because the use cases now that are starting to show up are sort of control your own destiny kind of use cases.
Is the spending on AI coming at the sake of traditional spend on IT infrastructure?
The number one case we still see is around security, and so security's always been high on everybody's list. There's never going to be a security winter. Cybersecurity is still top of mind. There's never going to be a recession in cybersecurity. So given that the number one case is still cybersecurity, I don't think it's a shift in spending. I just think it's the way they go about implementing cybersecurity is going to reflect whatever the latest technology is.
I think one of the other really telling things from your report was that 74% of CEOs said they're not aligned with their CFOs on the long-term value of technology investments. Is that telling us that there's some real tension on buying into an AI hype versus a business case use?
So I think that tension is actually quite good, I think. But there's tension in other parts of the C-suite. So I'll come back to the importance of alignment at the C-suite level. We see over and over again the companies that are furthest down the field in AI are the ones who have alignment at the top. There's also a distinction in our survey results between how CEOs feel about their workforces and their workforce's readiness for AI versus, say, the CIO's readiness. So there are lots of points of contention within C-suites around what's the business case, are our people ready, show me the use case. I think all of that gets worked out fairly quickly, and those who work it out the fastest are going to be the ones who are furthest ahead.
What about this idea of innovation theater? Companies that are announcing AI just to announce something splashy and AI related. How common is that?
I think based on the work we've done with our customers, I think our customers would say we have a lot of people showing up talking about AI, but it's really not their version of AI. And so I do think the hype machine is not going to stop here. Customers, though, they're pretty good about discerning what's real and what's fake and what can somebody actually deliver. I mean, for Kyndryl, we run the world's infrastructure, so we sit in a different spot from most of the others, and we have a different set of technologies, and we have more data than anybody else does. But the hype machine is out there. Customers are going to pull this apart pretty quickly, though.
All right, thank you for helping us distinguish hype from reality, Martin. This has been a pleasure. Please come join us again. That's Martin Schroeter of Kyndryl. Now, elsewhere, it's been a tough market today because of some of the bull case for generative AI losing steam. Analyst Alex Haissl at Redburn has cut his rating on Microsoft and Amazon to neutral, saying that the Gen AI boom is not the next cloud. He says weak economics, costly infrastructure, and fast appreciating hardware raise the risk of an industry overbuild. I am pleased to say that Alex joins us now. Alex, I mentioned some of your thesis just there, but can you get more into the detail? What drove you to issue this downgrade?
Yeah. Thanks for having me on the show again. As you know, there's like this narrative out there that generative AI is like the early stage of Cloud 1.0, and our work really shows that this is increasingly misplaced. Purely from a capital deployment perspective, we estimate that generative AI deployments require 6 times more capital to deliver the same Cloud 1.0 economics. And that's something that really surprised us in our analysis, and that's why we downgraded, heavy-hearted our hyperscalers. So I think it is really the economics are far worse than what we and that the market also believes.
So how does this end then, Alex? Because for these companies, it's been full steam ahead. What becomes the catalyst for them to realize exactly what you're saying, that they aren't producing the results to continue to justify the spend that they're undergoing?
Yeah, I think, both the optimization cycle, generative AI was quite welcome because it gave initially like the growth boost. So from a, top line perspective and also operating margin perspective, it doesn't look bad. But where you really have to focus on is on the cash flow generation and the cash flow conversion. And I think what will make them, slow down spending is just that the equities just derate because it will become more obvious that the economics just don't stack up to what they've communicated.
Maybe now is the start of that, Alex. You are starting to see some of the shares fall, but this downgrade you've issued, it's rare for these companies. There's so much enthusiasm. We were just looking at the Bloomberg screen of analyst recommendations. More than 90% of analysts covering these two stocks have a buy equivalent recommendation on them. How difficult is it to break from the trend in this sector that has a lot of hype, Alex? There's been a lot of careerists talked about of being willing to step away from the pack in stocks that had been red hot until recently. Was that a difficult decision to make just because of the pressure in the success, again, maybe until the last week of these share prices?
I think it has been a difficult one because we have been above consensus for a long time. We have defended these companies for a long time. But I think what is fundamentally different is, just to be clear, the cloud was perfect because the hyperscalers have captured the software layering economics on top of the infrastructure. If you believe that generative AI is big, the likes of Anthropic and OpenAI act as a platform, so they will capture more of the economics. But yeah, we need to be independent, and if the figures and the numbers tell you a different picture, you're just gonna act accordingly.
So what is kind of the balance to strike for these companies that are investing in something that for them and for many people, and okay, most people, that AI holds lots of promise? Is it a case, Alex, of just over-investing, or is it just completely misplaced faith?
I think, most of the growth in terms of like compute and spending is just still driven by consumer inferencing and also like training, and actually on the enterprise adoption where API is the best indication, it's mainly software development. So if you were to break it down, it's a software development, so coding cycle, and they have to invest, they have to be part of it. And I think the risk that they overbuild is significant because we are basically scaling at a very inefficient stack because they haven't quite worked out, the efficiencies. And that's very different to the cloud because the cloud really started to scale when it was really efficient. So I think there is an increasing risk there of overcapacity, and a lot of these projects may end up not generating any value at all. It could be negative.
Alex, one of the things that the common refrain of guests that come on here will say, okay, maybe there is going to be this moment of overcapacity, but it won't emerge until 5 years from now, maybe even more years, that it's going to take some time to really realize what the current dynamic is. Why go in with a downgrade now? Why not say it's going to take some time to figure things out, but for the meantime, these companies are going to be the beneficiary of an AI build-out?
They're simply not the beneficiary. I think the market is telling you already. We've seen a third quarter where across the board, top-line expectations have been beat, buy-side expectations moved up, and yet the stocks, started to derate because investors have upskilled and, people start to look at the economics much more than the top line. So if we make this call later, it's too late.
It's a fair point, Alex. We're finally looking at more into the balance sheet than what used to be the case for these tech companies of just being like, hey, that's a nice cash pile you have there. May I have some of it? Considering how much things have changed, that these once asset-light companies are now asset-heavy, that depreciation costs start to stack up. Just how different is it to be a tech analyst right now? At Redburn, how differently are you looking at these companies as a completely different prospect than they were just a mere 5 years ago?
They are capital-intensive business models, so you have to take a very different approach. And my focus is basically just on the hyperscalers. And I think there's one other point that is quite important because, these companies always try to tell you that this is very similar to the cloud 1.0 early days in terms of economics, but it's simply not, because in the early days of the cloud, these companies have assumed, a 3-year server lifetime, and now we're starting off with generative AI with a 5 to 6 year server lifetime. So it's very, very different. I think the debate is becoming much more nuanced, and we advise investors to be much more critical.
Hey, Alex, just quickly, because obviously what Nvidia does also drives a lot of the companies that you oversee. Is there anything on Wednesday that would make you feel more positive about the companies you cover, about Amazon, about Microsoft, about Oracle?
Not at all. No, I think for us it was not a short-term call. This is like a structural issue for the industry. It's not going to change our views.
All right, Alex, we'll leave it there. Thank you so much for joining us this morning. That is Alex Haissl of Redburn after a downgrade for Amazon, for Microsoft, both those shares leading the losses in today's market alongside Nvidia. You can see that price there. Now, elsewhere, another stock that is falling is Home Depot, the world's largest home improvement company, saying that consumers are hitting the pause button on big-ticket purchases. Home Depot cut its full-year guidance, sending the stock lower this morning. Telsey senior analyst Joe Feldman joins me now. He has an outperform rating on Home Depot with a 455 price target. Joe, it's the new economy and the old economy struggling this morning. Home Depot earnings, what's been your initial take on what we heard from the giant this morning?
Well, we were definitely disappointed by the earnings that we got out of Home Depot. We thought it was going to be a little bit better. I think the whole street thought it was going to be better. The however is that the lack of storms, there were no hurricanes in the third quarter, that they did have a few last year to compare against. That was a big driver, and, there has been a bit of a slowdown in spending. But when you look at the underlying trend at the business, it's still about the same. Last quarter they did probably they did a comp of 1%. Home Depot just said on their earnings conference call, if you adjust for, the storms, you're probably still at around a 1%, which is what our math had showed us as well. So, they didn't do that bad. I just think the expectation was high heading into it, where last quarter they got optimistic. They said, hey, second half, we feel really good. We're thinking that trends are starting to improve, and you're going to see a bit of a lift in the third quarter and the fourth. They basically had to walk that back today. And I think that's where there's been a little disappointment and frustration. But again, they didn't sound too bad. They're taking market share. They're executing well. There's some good things still happening at Home Depot.
If they're taking market share, then what does that mean for when we get Lowe's earnings, just, on top of some of the trends you're just talking about weather? Does that mean we're about to get a lot worse from Home Depot's peer?
Well, Lowe's has been underperforming Home Depot a little bit this year. Numbers have been coming down into the print for Lowe's. And so after what we saw from Home Depot, we would expect, yes, you're probably going to see some softer trends out of Lowe's as well. That being said, the two of them have both been gaining share from a lot of the independents out there. I think collectively they have like 45% of the market share out there. So there's still a lot to be had from others. But our concern now is that Lowe's could be a little bit soft, and we'll probably hear similar things where the consumer is buying and they're replacing products, like they replace appliances when they need to. They're doing small projects. They're just not doing the big projects.
Well, there had been a narrative emerging, again, kind of what you're talking about, Joe, that the consumer is weak. But considering the fact a lot of what Home Depot said of the trends that are still improving, would you push back on that narrative that the consumer isn't getting better, that these earnings highlight some real stress that still exists out there?
Yeah, I think these earnings do highlight some of the stress consumers have. I mean, it shows a lack of confidence in taking on a very large project like redoing a bathroom or a kitchen, which costs a lot of money. I think people are doing the necessities of upgrading and, the repair and maintenance of a home. That still happens. I mean, let's not forget, Home Depot just put up $41 billion of sales in one quarter. I mean, that's a really big number. I know everybody wanted more growth, but still, that's a lot of sales. So people are spending on their homes. They're doing what they need to. They're just not spending the way we would like to see, and you're not seeing that growth that would happen when you have a healthier housing market and a little bit more confidence in the economy overall.
Well, for the most part, Home Depot has been able to maintain prices, maybe because a lot of the imported goods arrived before the latest tariff increase. Joe, does that change at some point?
You know, Home Depot talked a little bit about passing through some prices related to tariffs. They said that they didn't see too much pressure from it. It's also a little early. The quarter was clouded by the storm impact, that they didn't have storms. And so it is a little hard to say. But we are seeing prices flow through across retail. I mean, that's for sure. We do a study and we publish it this morning every Tuesday, and we've been tracking since April. And we've seen prices come up on a lot of goods across retail. Some have come down, but the vast majority have gone up, and it's tariff related. And we're assuming that you're going to see that happen continuing into the fourth quarter and beyond. Really, the first half of next year, the consumer is going to have to adopt to that.
Joe, as it also relates to politics, Bloomberg columnist Beth Cowett wrote earlier this month saying that Home Depot has an ICE problem, that arrests happening in the parking lot of Home Depots have become inextricably tied with the company. And it's a company that's remained silent on it, but shouldn't, just because of the workforce, the day laborers that are so important to the business of Home Depot. Would you want to hear the company address this more head on?
You know, we've talked to them about it. I think most analysts and investors have talked to them about it. The people that ICE is targeting, they're not actually Home Depot employees. You know, they are day laborers. They congregate near Home Depot, near Lowe's, and other areas where there's a lot of, high traffic, especially among contractors and pros that are out there. And so it's just to make it easy, because a lot of those pros might need some help for a particular day, and they pick on, some of the day laborers and give them some work. So it's sort of a bad coincidence that it has to happen there. And I understand why, that's where the pro goes to shop. And so they see people and they can help. But they're technically not on Home Depot property. They're not Home Depot employees. I know it's not a great look optically, but it just, it's part of sort of the nature of how that worker or laborer operates. I've seen it in my neighborhood. I know there's some areas where you can go and you see some day laborers on a Saturday or Sunday morning waiting to be, picked up. And, ICE is doing what they're doing. And I think Home Depot and myself were going to try to stay out of the politics of it.
All right, Joe, we will end it there in that case, rather than drag you into the politics. Thank you so much for joining us this morning. Telsey Group's Joel Feldman, on a day where Home Depot shares down just under 4%. Coming up on the show, President Trump is set to meet with Saudi Crown Prince Mohammed bin Salman today in Washington. We head to the White House next. You're watching Bloomberg.
I have concerns about the sale of F-35s to Saudi Arabia or any nation that could not assure the United States that technology and the great advancements that we've made with the F-35 don't fall into the hands of nations that are hostile to our interests.
Former Vice President Mike Pence speaking to Bloomberg, and those concerns coming after President Trump said that he will sell F-35 fighter jets to Saudi Arabia, a major concession to Crown Prince Mohammed bin Salman. The two leaders will meet in the White House within the next 2 hours, and that's where Anne-Marie Horder, Bloomberg's chief political correspondent and co-host of Surveillance, is standing by. So, Anne-Marie, the fighter jets, is that going to be the main point of conversation between these two world leaders?
Well, there's a number of issues these two leaders are going to speak about. And when the president talked about a dawn of a new Middle East back in May, when I traveled with him to Riyadh, today is going to be a continuation of that bilateral relationship this president has with the kingdom. Strategically, the kingdom is looking to the United States as opposed to China when it comes to a number of important issues, when it comes to AI and chips, when it comes to defense, when it comes to energy and nuclear. So we're going to hear the president and the Crown Prince, Mohammed bin Salman, talk amongst a number of these issues. Remember, Saudi Arabia talked about $600 billion in investments when the president visited the region. This trip is really about inking many of those agreements when it comes to chips. Where are the export licenses? Who is getting them? For what sort of chips? And then when it comes for defense, of course, the president saying that, yeah, they're going to allow them to export the United States F-35s. That is going to be a critical topic. There is questions about Did the president speak to the Israelis? Are they concerned about not having an edge in the region? Of course, remember with F-35s, this is a first step and a big win for the kingdom, but this is going to be years in the making. All of these kind of defense equipments, especially the most high advanced stealth jet the United States could export, has a tremendous amount of security requirements that go with it, and also licenses that can be upheld by Congress. So it really is a continuation of May and the progression of this bilateral relationship that will be on full display here.
Until recently, Anne-Marie, it was a Saudi leader that had been shunned by a lot of Western allies. A different approach from the Trump administration, but when these deals are being struck, to your point, the F-35, a lot of things need to go right, a lot of security checks that take a long time to happen. How do they ensure that these are deals that last beyond the presidency of Donald Trump?
Well, that's a great question, because when you speak to a lot of sources abroad, what they talk about, what is uncertain with the United States, is the 4-year election cycle. And you hear that as well from America's C-suites when it comes to flipping between Democrats and Republicans. What I will say in regarding the Saudi Arabia relationship, which obviously there was a tremendous amount of criticism after the killing of Jamal Khashoggi in the Istanbul consulate, Saudi Arabia's Istanbul consulate, we did see the Biden administration. Biden called Saudi Arabia a pariah and then went to the Middle East when gas prices were too untenable for American consumers, and there was that awkward fist bump. And the Biden administration then strategically knew that Saudi Arabia was an important partner in the region, in the Middle East, an important economy in the region, that they started even some of these conversations that President Trump is going to be continuing today.
Anne-Marie, before we let you go, there's also going to be a dinner. Some of the attendees, Punchbowl reporting that Tesla's Elon Musk is going to be there, which will be interesting to see the president and the former first bro be reunited. But how much of this is not necessarily just about MBS and its relationship to the White House, but MBS and American tech companies?
That's a great question, Danny, and we saw that on absolute full display when the Saudi Investment Fund had their Davos in the desert. You saw executives from around the world, especially the United States, engaging in dialogue for MOUs, for serious business deals with U.S. companies. The likes of Nvidia's Jensen Huang is an individual that stands out for me, because on that trip, he was alongside the president, and the president made it very clear, pointing out to all the executives that traveled with him to Riyadh to talk about this $600 billion the kingdom was willing to invest. I remember him saying, my friend Jensen's here, Tim Cook isn't here. Tim Cook hasn't missed a trip yet abroad. He was there in the United Kingdom and Japan. But for this administration and for the kingdom itself, it's very important to not just have the bilateral relationship, but also have those relationships with executives.
Anne-Marie, thank you so much for joining. We look forward to your coverage throughout the day. That's Bloomberg's Anne-Marie Redburn. Coming up on the show tomorrow, Andrew Slimman of Morgan Stanley, Gabriela Santos of JP Morgan, and Raj Danda of Ares Management. Plus, we'll have the CEOs of Fortress, TMX, and MFS Investment Management. That's it for Open Interest today. Tech is up next.